All right. Thank you everyone for attending this month's market update webinar for the month of August 2026. Let's start, as always, with some disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk unless otherwise stated are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed in the presentation. And of course, past performance is not a guarantee of future results. You can learn more about our disclosures on our website if you so wish. And throughout the webinar, you can use the Q&A button at the bottom, and we will address them at the end. A little bit about us. Silverstone Financial is a fee-only fiduciary independent wealth management firm. We provide various wealth management services, including financial planning, investment management, tax preparation, estate planning, and so on. You can learn more about us on our website. And my name is Jeremy Eppley. I'm a financial planner. I specialize in inheritance and estate planning. Gordon, my co-host here, is also a financial planner who specializes in retirement planning and values aligned investing. And we can probably hop right into this month's market performance. So I think I might see some new faces here. So for those of you that haven't been here before, what's on the screen is a heat map. This is my favorite way to watch the markets. A lot of people will maybe log into Yahoo Finance or Google Finance or whichever way that you're checking what the stock markets are doing, and you look at indices, and you'll see what the S&P 500 does, and it's 500 companies, and it's consolidated down to one number. However, when you look at a heat map, you can see really what the market's doing. So the heat map is sectioned into the 11 industries, where you got technologies, financials, consumer cyclicals, and so on. And then within each of the industries, you have sub-industries showing like software, semiconductors, aerospace, oil, and so on. So it's organized by the type of company. And the larger the box, the larger the company by market cap, so the value of the company. The redder the box, the worse the company had for performance that over the period of time. For this is the month of July. The greener the box, the better the performance. So for those of you that are also on podcasts, you can always go to YouTube, to our YouTube channel, and watch the replay if you want to see our pretty graphs. But I'll try to explain it as best I can for those that are just listening. So you can see definitely on the heat map some bright red spots. You see some of these semiconductors companies, bright red. SpaceX doing its own thing, bright red. Tesla being tied very heavily to SpaceX. Some drug manufacturers falling. You see some utilities and such. All of these I would consider, so utilities, the semiconductor equipment manufacturers and such, I would consider them all part of the AI trade. So July was a little bit of sell-off from the AI trade, and there's some interesting news stories later on in the presentation that we'll get into. That what happens when a hedge fund goes too all in on AI, and some bad things that can happen. I'll quickly go through some indices on the side here. So the top 50 largest companies in the S&P 500. So the S&P top 50 were down almost 1%. So the mega cap names did worse on average than the S&P 500 as a whole. The S&P 500 as a whole was traded mostly flat, was down 0.1% for the month. GARP, so S&P 500 GARP, growth at a reasonable price, is one of our favorite ways to invest. It filters the S&P 500 down to the top 75 stocks that both have growth but also aren't too expensive. That was up 2.4% for the month. It's been lagging for the past year or two, our preferred investment strategy. And so this month there was a little bit of a reversal back to the basics and the fundamentals instead of the AI high flyers. And then small caps were down almost 2% for the month. Global ex-US were about flat. So those are non-US companies trading about flat. Bonds fell slightly this month at about 1% down. Gold up almost 2%, 1.7%. Crude oil spiking at 22% for the month. You can definitely see that translate into the oil companies right here, bright green. That has to do with the Strait of Hormuz and all the different things happening in the Middle East. And then Bitcoin up 7%. Do you have any interesting viewpoints on this, Gordon?
I'm just trying to find where Oracle is on this map. I feel like last
Right.
couple of months. Oh, there it is. Okay. Next to Microsoft.
Yeah, it's one of the big software names, and
Hmm.
they provide compute to the various AI companies, and they do lots of other things.
Hmm.
Owned by the Ellison family, I believe, and
Right.
they're quite leveraged. They have gone out and put their stock that they hold privately against a big bank loan to buy Paramount or to buy Warner Brothers
Hmm.
for Paramount, which
Right. And
which
we'll be talking about that later, but it looks so they've stabilized in July. Let's go to the next slide and we'll see how it is year to date. Okay, so not so
yeah,
bad.
not they had jumped up quite a bit with the AI trade with some names around what they were expecting for OpenAI because they had these deals
Hmm.
with OpenAI, and then it crashed pretty heavily. But it looks like it's at least year to date pretty flat. Oh, this is the 1 month performance graph. This is not the year to date graph right now. I'm seeing. Yeah. Let me real quick grab the year to date graph and we can see what actually is happening. We apologize for that. All right. So this is actually where we get the graph is from FinViz. If any of you are interested, it's a great website that shows lots of financial visualizations of what it stands for. But
Yeah, it looks like Oracle's actually down 25.92% year to date.
yeah,
So, um, yeah, I was I was quite surprised that it had bounced back so much. So,
year to date, yes, bright red.
there we go.
Um, See, it's good to know specific companies what they're doing and how we can point out that we had the wrong graph. I would apologize.
Um, well, it's not as bad as SpaceX. And SpaceX did that 25% plus drop in just a month. So,
Yeah. Well, SpaceX really should never have been valued that high in the first
correct.
place. It was. We have a whole YouTube video. I'll probably mention at least one more time later on in the presentation that if you go to our YouTube channel, we have a 20-minute or so a video on the SpaceX IPO. We did it before it launched, and our recommendation was not to invest in it. The fundamentals didn't line up with the what the IPO was going to be priced at, and so it was priced in a ridiculous fashion. And it spiked a whole lot the first few days while there was a whole lot of hype, and then it has crashed quite significantly since then. All right, should I move on to next
Yeah.
slide, Gordon? So um, these numbers should be correct. The indices year to date, we see the S&P 500 up almost 10% for the year. S&P GARP, so that's the more fundamental way of investing, up slightly better than the S&P, but not by much. Small caps outperforming almost twice the S&P, so smaller companies doing better than the S&P 500. Global XUS up almost 13%, so slightly better for the year than US markets. Bonds are mostly flat for the year. Gold slightly down at 5%. Crude oil up almost 50% for the year. Again, a lot of that has to do with the Iranian war. And then Bitcoin down 30% for the year. We could probably move on from some of these indices. Uh, I'm not going to spend too much time on this graph. We showed each month. It shows the seasonality and cyclicality of the markets. The outside shows historical returns per month, and the inside shows what actually has happened. And for July is usually a pretty good month, up 1% on average, and we were down 0.1%. So did not follow the seasonal trend. We do expect August and September are often the worst months of the year, So it is possible that this third quarter will continue as it has historically done of underperforming and potentially losing money. But that does not mean that we recommend selling or panicking around your investments. The best strategy is to stay invested and to, if you're adding to retirement or so, do it every single month, dollar cost average your investments. So not trying to panic anyone. But if you see markets falling in the next 2 months, it is at least historically normal and nothing to worry too much about. All right, Gordon, let's talk about your graph of the month.
Yeah, so when we see changes in GDP, a lot of times there are kind of hidden factors going on, changes in trade, and in this case, we've been seeing inventories which really built up during COVID, and then they've been kind of gradually being worked through, as is a normal thing to happen when there's some growth. So last quarter's results for GDP came out last week, I think it was, and it was only 1.5% for the second quarter. A couple of things to remember. First of all, they do three estimates of GDP, so this was just kind of the first initial look. More and more data comes in. Putting together the GDP numbers is an enormous amount of data, surveys and reports from companies, and they vary in how long it takes them to get data to the federal government. So, 1.5% is not the final number, but it was interesting this quarter. One of the drags on that was this um, using up of inventories. So, um, I thought it was interesting, and it's kind of normal when you see when we come out of the recession there in '02, right when the gray period ends, there's usually a bump up. And you've seen that in every one of these at the end of these three bars here. And then it kind of gradually comes back down. Um, just one of those factors that's part of the business cycle that we don't often think about. Uh, but when the GDP numbers come out, um, it's one of the important components.
Should I move to the next slide?
Yep.
All right, well, I have my graph of the month here. So this is a really interesting one that I saw. In this light blue are hyperscalers. So hyperscalers are the really large cap companies. So you can think of Microsoft and Google and Facebook and those companies. And the dark blue here is the semiconductor companies. So that'd be mostly NVIDIA and such. And you can see right when AI was seen as the future, and there was a whole lot of capital investment by these massive companies. You can see this is the free cash flow for the companies. So we saw these hyperscalers, Google, Microsoft, Facebook, are uber profitable companies. That's why they're so valuable. And they were making 250, almost $300 million in free cash flow each year. And that's where it peaked at. And then they decided, oh, we need to double down on this AI investment and we need to buy. Yeah, go ahead.
That's billion.
Oh, billions. Yes.
Yeah.
Well, I just missed three zeros. Not that big a deal. But they were being super profitable, 300 billion, let's say, in free cash flow. And then they decided they needed to invest heavily in these computer chips from NVIDIA and other companies to be able to support this AI build out. And so you can see where all the cash flow went. All this cash flow from these very profitable companies went straight into the pocket of NVIDIA and these other semiconductors, which is why you saw such huge gains in these semiconductor companies. And some hyperscalers, some of the largest cap companies have slowed down they haven't done as well with in their stock prices. Now, Google is one of the exceptions because they're also an AI company versus like Microsoft or Meta or isn't really it doesn't have a native large language model like Google's Gemini. So really interesting to see this being very important, where we see hyperscalers' free cash flow being negative for the first time since their inception, which is why some of these earning calls, you see these incredible earnings numbers. However, their free cash flow is negative. So you see like Google dipped after their earnings and some of their other hyperscalers are having trouble after earnings. So they're very profitable. But because the cash is all getting thrown back into these AI chips, some of the stocks are struggling.
Yeah, it's interesting. You have these companies that were sitting on a lot of cash. Apple, Google just had a lot of cash with nothing they didn't see anything worth spending it on until, until the AI, this cycle started. And so one of the things that boosted their stock prices was that, well, they've all, if whatever they're building now becomes less profitable, they have all of this money set aside that they can invest in whatever the next new thing is. Was kind of the one of the stories about how to value these hyperscalers. And now they're spending that cash. And so now the question is, if they're maybe they're more risky now because they're not building up this cash. They're making a big bet on AI, and AI is gonna be a tremendous industry for the foreseeable future. But that doesn't mean that it's going to be generating big profits for the companies that are buying it necessarily. The problem is that AI works really great when a company has very organized data, very well-defined process flows. And so, my skepticism around it is more just like, how much is it really going to improve efficiency in the short to medium term? In the long term, yeah, AI is going to be transformative, but um, we'll see how well this pays off for these companies that are investing hundreds of billions of dollars into it.
Yeah. And I also want to note free cash flow is not profitability. There's still
Right.
profitable companies and they are buying assets that could technically be resold. Now, old GPUs or a few-year-old GPUs still have value, but they do depreciate relatively quickly. And as Gordon said, they have huge cash hoards. So them dipping into their cash hoards to reinvest isn't necessarily problematic. They've deemed that this is going to have a return on investment. That's why they're doing it.
Mhm.
But it is interesting to see that every year they were saving money into their cash hoards and they were able to use that to pay dividends or buy stock or buy competitors or whatever. And now all that is being translated right into the semiconductor stocks. So very interesting.
Right. The trend is shifted, and the perception is changing.
Yeah. And also a lot of the free cash flow of these semiconductor stocks, you see Nvidia buying stakes in a lot of companies. So they also know that this is not going to be like this forever. Where after the build outs happen, there's going to be less capex spend on these AI chips. So they are trying to translate their newfound free cash flow into equity positions in a lot of times these other hyperscalers that will be more profitable long term. That's at least my read on it. All right, let's get into some notable events for the month. So the biggest one, at least for in my world, where I'm bombarded by financial news, and it's interesting to see some of the memes on some of the Wall Street some of the Wall Street meme accounts on Instagram and such. The biggest one that hit this month for me was situational awareness blowing up, basically. So situational awareness was a hedge fund, maybe is a hedge fund subsidiary. I'm not actually sure how it all is going to shake out. But situational awareness was a hedge fund founded by this guy. His name is Leopold Aschenbrenner, if I'm pronouncing it right. He's a German guy. He's 25 years old, or when he launched it, I think he was 22 or something. Very, very, very young. And he raised something like $25 billion in this hedge fund. He was an OpenAI researcher, considered some boy genius, and he switched over from OpenAI to saying, well, I understand AI companies super well now, so I'm just going to start a hedge fund, raise money, and I'm just going to beat everyone at their own game because I'm just going to be so much better at managing money. And to note, no finance background. He was um, uh, a AI researcher first and foremost. He does not have a finance background that I know of. Anyway, so he raised 25 billion or so and invested in lots of different AI companies at different levels. A lot of times there are sort of five layers to AI, where you have like the semiconductors, and then you have the LLMs, and then you have the compute, which would be like Oracle sells compute. The LLMs would be like OpenAI, Anthropic, Google. The semiconductors would be NVIDIA and such. And then you have the actual front end that are using the LLMs to create the end product for clients. There's a fifth one that I don't remember. I remember someone explained it really well, the five layers, but at least I got four for you. So he was investing in all those different layers. So some of the LLMs he had holdings in OpenAI, I believe, and he was investing in NVIDIA and all this kind of stuff. And he was crushing the market. And whenever you see someone crushing the market, because he was up like 1,000% this year, something ridiculous. In the stock market was up 10, 20%. So like how do you get to 1,000%? So my mind immediately goes to Bernie Madoff, where you got some sort of fraud and it's a Ponzi scheme and you're lying. That wasn't the case here. What the case was he was 4x leveraged on these AI companies that are already very volatile. So he was able to get some. I don't know how he was able to get four times leverage, especially on this. I don't know who gave him the money and such, what bank, or maybe he was using derivative contracts, which is a way to get around it and have synthetic leverage. But these AI names that were hyperbolic already, he was getting 4x leverage on them, and people saw his returns and they were, oh my God, I need to FOMO, I need to get in on this. People were throwing money at him, so he had more money, so he would buy more stock. And at $25 billion, his fund got up to 45 at the end. You can move markets. And if you are buying the AI stocks and there's only so much few shares available to buy, you buying at whatever price with leverage is going to jack up the price of the market and of the stocks. And so on paper, the value of the company has kept going up and up and up, but he wouldn't be able to sell them. Like if his clients were like, okay, well, great, you've made so much money, now return those returns to me. If you try to sell it, it'll all reverse and it would go to close to zero because he was on leverage. And when you sell it, there has to be buyers to actually be able to realize those gains. So there was a small rout, let's say, in the past month and a half, where AI names weren't going up, hundreds of percent every single month or whatever it was. So, oops, a pebble got in his path, and he tripped quite badly, let's say. So that when you're on margin in finance, so margin's a type of leverage. So you go to a bank and say, I would like to borrow money, I would like to invest in these companies. The companies you're investing in are the collateral, and you have to keep the equity you have in your portfolio, which means how much you actually own versus how much is leverage, over a certain amount. So there's called a margin call. So if stocks fluctuate and you fall below that amount, the bank says, well, you're too risky. He was probably too risky in the first place. But the bank says, okay, you don't have enough equity. We can't be lending you this much money. So we're going to force you to liquidate those positions and give us our money back until you get to the equity level that we're comfortable with. And what happens is when you're super leveraged and you have super hyper concentrated positions in very volatile companies, well, you have the opposite of a short squeeze. You end up having to sell to cover, which makes the market tank, which means you have to sell to cover, which makes the market tank. You keep getting margin called all the way down. And so basically his portfolio blew up. And another hedge fund, the largest, I believe the largest hedge fund in the world, by Ken Griffin, is this guy right here. He runs Citadel. He came and snapped up and bought the hedge fund out of basically what I think was going to end up being bankruptcy. It's like they owed too much money to the banks, and he just bought all the assets at pennies on the dollar. Really interesting story. I don't want to take away that don't trust a young guy to manage your money. Hopefully, you guys still trust Silverstone, but I would say don't necessarily trust someone that has no finance background to beat the market. And if you see 1,000% returns and the market is not anywhere near that, that should be a red flag, not a green flag. Anything to add to the story, Gordon? Did I explain it well enough, or did I go too much into the weeds?
Uh, I think that was great. I think that Citadel, they know what they're doing, and um, in this case, one person's failure is somebody else's opportunity, and so um, that's how it usually works in finance.
Yeah. Yeah, Citadel is definitely one of the. There's definitely people that dislike them quite a bit. If you can imagine what a hedge fund does, and some of the bad things that you can imagine, Citadel is pretty much an epitome of that. But yes, they are very sophisticated. I don't think you can take that away from them. And when they see an opportunity, they pounce. I think it was within less than 48 hours they had spent billions of dollars to buy this out of nowhere before anyone else had a chance to go for it. So very impressive and a cautionary tale.
Hmm.
Talking about cautionary tales, another one is about the betting markets. So if you've come to lots of our webinars, you'll hear us say again and again to beware of the betting markets. We see a lot of these betting markets. I forget the percentage. Maybe Gordon knows it off the top of his head, but it's like less than 1% or something like that, or less than a few percent of people that bet on Kalshi or the various prediction markets make money. The large majority are net losers. It's similar to those that very few people are able to consistently beat the stock market. It is just very difficult to do. And the ways you do it is you have inside information. And of course, that's illegal in stock markets because they're heavily regulated. And it's still technically illegal in the prediction markets, but there's much less infrastructure and regulation around to protect people. So there is a rampant amounts of fraud and or people having unfair advantages and edges and knowledge and using that to insider trade on these. So the headline of this month, and there's been one basically every single month if you go back to in our past webinars, White House teleprompt operator was placed on leave after betting on Trump speeches, basically what he would say in a Trump speech. And shocker, he knew something that everyone else didn't, and he made more than $100,000 and then was fired, or at least put on leave. I don't know if he's actually fired or they'll let him quietly come back later on. We'll see. But I don't know how much money a teleprompter operator makes, and I don't know if he'll be prosecuted or try to have that money clawed back. But I would say it's unlikely, and perhaps making over $100,000 is more than he would have made at his job. So you can see why there are these pressures and these incentives to take advantage of these markets. So beware, and we in general don't recommend using these prediction markets. If you're betting on a sports game or something, keep it, don't go crazy. But if you are doing other things of like betting on what Trump is going to say or some other, how many people will go to Taylor Swift's wedding or X, Y, or Z, either you don't know and you're guessing, and someone else does know on either end. So beware. Um, all right. So U.S. Japan. Gordon, do you want to take this one? I think we
Yeah.
had both. Okay, go for
Yeah. So, the this is goes back a little bit to something we've talked about in the past. I'm not sure how long ago it was when we were talking about the carry trade,
it. Yeah.
which was this idea that the spread in interest rates between two different countries um, presents an it's sort of a type of arbitrage, which means where you're buying an asset on at one price in one market and selling it at a higher price on another market. And so, but the difference in interest rates between the US and Japan were creating this situation that was basically encouraging people to sell yen. And at one point, when the Fed under Chairman Powell had reduced rates quite a bit, um, they got pretty close. Well, the thing is that the Fed only controls the shortest term rate, right? The overnight rate, what they call the discount rate. Um, there's also another rate called the Fed funds rate, but they basically do the same thing that they control the very short term lending. Well, in so far this year, the 2-year Treasury has gone up 71 basis points. So that's about 71% of 1%, 7/10 of 1%, which is a big move in historic standards. That's a big move for 7 months. And um, So what we were seeing was the carry trade reignited, slightly different types of treasuries that were being moved. It's not as intense because it's not like overnight bank lending, but it was causing the yen to weaken because, why keep your money in yen that only pays 1.5% when you can keep it in dollars and it's paying, almost 4%. I think it's 3.5 is around is the 2 years at. Um, and so the U.S. wanted to help to have some stability there. And so with this coordinated action, what its purpose is to signal that, we're not going to let the yen deteriorate in some kind of rapid fashion. And they're not going to let speculators just drive that down without consequences. Um, so that's what that cooperation is about.
Yeah, they're trying to prevent speculators from breaking the bank. Was it George Soros that broke the Bank of England or whichever one?
Yep.
There were a few hedge funds. There was another one that broke. I think it was Argentinian bank back in the 70s or 80s or something. So there are a few times where a large enough hedge fund with the right kinds of investments can beat a central bank of a large country. Um, if they have enough coordinated efforts and enough cash to try to push off a peg or try to push off a currency from how it normally trades. So this is kind of trying to stabilize things. And it was interesting because those that don't follow carry trades or don't follow international finance probably didn't know that anything was wrong. And then we see this
Mhm.
big announcement from the U.S. and Japan. One thing to note, Gordon said a carry trade is a type of arbitrage, and it definitely is seen that way by a lot of people. But to note, so arbitrage in finance, the actual definition is it's risk free, where you
Right.
guarantee that you are starting on one end and you have a guaranteed outcome on the other end. So you know what's going to happen. So it's just free money. And arbitrage is important to bring various markets and exchanges into equilibrium. If there was free money, someone will take that free money until everything is back in equilibrium, which is an important way to make the markets efficient. A
Hmm.
carry trade is uncovered, which means you are holding debt of another country. because it has lower interest rates and buying assets from another country that has higher returns. But there is nothing guaranteeing that the exchange rates are going to stay the same. And so it's an uncovered investment, basically, or strategy. And the problem with the carry trade is if it ever becomes unwound, which I think it was last year, maybe November or something like that when we talked about the carry trade last. And when that happens, everyone, it's like a short squeeze. Everyone tries to get out of the position very quickly, which makes the problem worse and makes everything blow up very quickly. So you can make extra money very easily until something goes wrong. And then you have to be out before everyone else. And that's very difficult to be out before everyone else. So interesting to see. A big news in finance, but might not affect you or show up on your normal headlines.
Hmm. Well, it's the more short term the note that you're using, the less chance there is of it blowing up on you.
Yeah.
Um,
But you make less money, so what's the point, right? People gotta, get the longest term and have the best return. Uh,
I suppose so. Yep. Um,
Trouble.
and so yeah, thank you for clarifying that. Maybe arbitrage wasn't the best word to
I
use.
think arbitrage is a good point, a good way to describe it, because a lot of people think of it that way. But it's very important to note it is not technically arbitrage. Um,
Fair
all right.
enough.
So
Um,
you want to take Federal Reserve or
I'll start. So yeah, so Chairman Warsh left rates unchanged. I think not terribly surprising. Um, the some people were saying there's some kind of questions about his credibility. I don't really see it that way. The vote was 9-3, so there was some dissenters. Um, the interesting question is, did um, some of the three who voted against, did some of them actually want to raise rates? Um,
all three voted for raising rates? Yes.
okay. So, so Warsh in the majority, I mean, presumably Warsh would not be in the raise rates camp. Um, we don't know for sure, but so part of the Fed chairman's role is to try to build consensus, and 9-3 is still pretty good consensus, but it's I think it put to rest the speculation that he would somehow be able to jawbone, the rest of the um, board of board of governors to lower interest rates and follow the president's wishes. That's not going to happen, and the markets, the data will decide when the next interest rate change is going to happen.
Yeah. And so, Trump placed him, Kevin Warsh, onto the committee, and Trump was very clear that he wanted a race cut. And there was a lot of fear that Kevin Warsh would be, puppet head or whatever of just following what Trump said. And so far, he hasn't really done anything differently, significantly from Powell yet. He's put into place some task forces, and we'll see what changes over the coming months. But so far, Trump is still um, congratulatory or kind to Warsh. I am curious how long that will last. I don't think it will last forever. I think it'd be very surprising, simply because Kevin Warsh, I don't think will do what Trump wants of cutting rates, especially in this environment. So I don't know how long his patience will last with that. He also doesn't want to start criticizing someone he immediately had been talking great things about for many months and be like, no,
Mhm.
it's actually terrible. So I wouldn't be surprised if he starts criticizing him after the midterms, maybe around New Year's. We'll see. We'll see.
Well, Marsh is definitely going to do some things that Trump will like around deregulation,
Yes, that's definitely possible.
um, which is the other part of the Fed's role, which is maybe less talked about.
Yeah. Another graph I want to show this month, which is the federal funds rate. You can see these dotted lines are projected, and so the markets are now anticipating rates to go up. We will see if they actually do. So three of the dissenters wanted to raise rates. So this would be one step up, I believe.
Hmm.
So it's not a significant raising of rates, and it would continue to fall after the fact. But it looks like from now until the end of 2027, yeah, rates are going to be pretty flat because inflation is not fully gone, but they don't really want to be raising rates here. So I think it'll be pretty flat for a while. And if inflation comes under control, then 2028 and the longer run, we might be getting down to 3% interest rates. But we'll see. I think we're in a pretty stable environment. You know, this is pretty insignificant in comparison to some of these jumps here, or some cuts, or some of the jumps, or some of the cuts that we've seen historically. So we'll see if these projections are actually accurate. You got to always remember that projections were around here were flat, and around here were flat until they started going up and down. So projections don't actually tell you that much. It's mostly the projections just say if nothing changes, then this is what we'll probably do. But things change all the time. All right. So Apple sues OpenAI. I'm also seeing that we're around 45 minutes, so I'm going to try to. We have two more slides of events, so we're going to try to keep it high level from
All
now
right.
on. So Apple sues OpenAI. They claimed that there was trade secret theft. I believe that I had heard some of the grievances or some complaints was that OpenAI would ask various Apple employees to come to interview to join OpenAI as an employee. And they said, "How about you just bring some of the prototypes you're working on to show us how well you're doing, and like how you problem solve." And so it does seem a pretty blatant and open in check case. At least from the coverage that I was seeing, it was very in favor of Apple having a very strong case here. But we'll see what happens. These cases take years often to go through the court system. It is mostly interesting because this is a big fallout since Apple, of course, doesn't have their own LLM and has been seen as behind on the AI trade for a long time. They first launched, I think, last year, maybe a little bit before that. They launched their new Siri or whatever with OpenAI's backend assistance, and since then they have dropped that and have switched over to Google Gemini. And so it seems like this, and also it seems like Apple wasn't happy with how OpenAI software was going with them, integrating with them, but also this trade secret stuff probably was another very problematic clashing of the relationship. And it's important to note Google and Apple, although they're often seen as heavy competitors, and they are, iOS versus Android and all the other things that they compete in. They have one of the most amicable relationships out of all the tech giants. Google has been paying them over $20 billion a year for like 10 years to be the default search engine on Apple devices. And they do collaborate on a lot of things to make Android and Apple interact in a way that is not terrible, of course. I use Android. I'm a little biased against Apple. They've made texting the green bubbles, blue bubbles much more difficult than it had to be for decades. But overall, they have a pretty good relationship. I wouldn't be surprised that they go deeper and deeper into the Gemini ecosystem and making Siri basically Google Gemini, just with some more privacy protections and a different skin to make it look pretty to their iOS operating system.
Well, Apple's always been a hardware company. When the first Macs came out, I'm sorry, when Microsoft Office came out, the Apple's never had an alternative to that. They've always, used Microsoft. In fact, people say Microsoft Office runs best on a Mac. So,
Yeah,
um, yeah, it's no surprise that they're behind in the AI race.
yeah, yeah. Also, Google just has had a history of investing in these moonshot ideas of AI and quantum computing. I think, again, I've said this before in past webinars, but like in 10 years or whenever quantum computing comes out, it's going to be another startup that says, we have it going, just like OpenAI did. And then Google's going to say, we have one too, because they've been investing and have a lab doing quantum computing since 2010 or 2011
Hmm.
or something. So Apple has been very much one of the reasons why it's been so profitable for so many years is it's kind of a profit first company where they invest and they did the Apple car developments that they never fully announced, but like they will cut pretty aggressively things that aren't profitable or they don't see as being profitable. Google does that too, but I would say Google has a few more moonshots out there. You have Waymo and it's finally coming into profitability and such, versus Apple tries to stick with the hardware and trying to find ways to get more revenue based off of like their services line, but they're not doing crazy things like say a Google would be doing. Amazon, another one that does a lot of moonshots and is willing to spend money in hopes of very much spaghetti on the wall, trying to find something new. All right, another one I'm going to fly through. Apple commits $30 billion to Broadcom, which is a chip maker, to make chips in the US. We'll see if this goes anywhere. We've seen this again and again, various companies saying we're going to put lots of money into building chips in the US. And there was lots of that with like the first Trump administration and the Biden administration. They had like these groundbreaking ceremonies. And if you go to the places where they had groundbreaking ceremonies, there's still no factory there. So we'll see if they actually do build AI chips or chips in general in the U.S. Big news. It's going to take years to see if it goes through and if there are any hurdles that kill the project. Tesla. Tesla. We are seeing more and more signs in the various earnings calls and various speculation from Wall Street analysts that Tesla and SpaceX will likely merge at some point. I've heard people saying maybe 2027, potentially 2028. I don't think it'll be this year, but at some point, we would likely be seeing a SpaceX a Tesla merger. They already have a lot of overlap. They share engineers, they share plants to make batteries and stuff. With Elon being the majority shareholder or near majority shareholder in both companies, I think it is very likely we'll see a mega merger one day. I think it'll probably be a detriment to Tesla shareholders out of the two, mostly because SpaceX is ridiculously expensive, but is also SpaceX is ridiculously expensive because of XAI. So I think we'll see how it goes. They're both ridiculously expensive, and I would,
Well,
yeah,
Elon has locked in permanent control over SpaceX
yeah.
with the voting shares, and so any deal will definitely favor SpaceX because of that.
Yes, and I think he owns more of SpaceX as well, so he would want more of the value to go to the company he has more of.
Hmm.
Either way, it's interesting to see. And then SpaceX has been falling. We mentioned it previously in the webinar, but 19% ish from the IPO price of 135. I think it's hovering in the 105, 110 range right now. Down 52% from all-time highs, which was just over $200 per share. What I wanted to show, though, was this graph, which was the lockup schedule of SpaceX. So August 6th, which is tomorrow, we're going to have the first unlocking of a whole lot of shares. It's going to go up to this blue line here. It would have been up to this dark blue line if they were, I think, 30, let me see, if they were, I don't see the actual number, but it was like 30% above IPO price, then more would have been unlocked faster. But because they're below the IPO price, less are going to be unlocked. But it's still going to be more than doubling the number of shares available on August 6th. And then you see the step function every 3 weeks or so, another big jump until the end of this year, where there's a big jump in November and a big jump in December. And as supply goes up, share prices usually go down. Now a lot of that is baked into the price, knowing that these are happening, and is known. But what is unknown is how quickly insiders will sell their shares. There might some insiders that will say, "Okay, the market's been falling. I want to get out of this before it falls more," and it could be really detrimental. It could be the other way around. Of it was just $200 a share, you know, a month ago. Why would I sell at half the price? I'm going to hold on. So we're going to see, and we'll probably see a lot of volatility. If nothing else, we're going to see a lot of volatility. I can't tell you if it's going to go up or down. I think it'll probably go down, but there's going to be a lot of volatility.
That's huge. I didn't realize how many. It's going to double the number of shares tomorrow.
Yes, more than double, I believe.
Yeah.
Um, yeah, and then it does it again before the end of the month, and not double, but another huge chunk. Um,
And by the time we get to February, we'll be over 50 million. I'm sorry.
50%.
Is that millions on the left?
This is a percentage.
Oh, I see. So we're going to go from 555 million, 5% to half. So it'll be 10 times more.
Yeah, and basically all of this doesn't matter as much. This is basically all Elon. The extended lockup period, I believe, where he owns 40% or something of it. So most of it is all locked up around here. So most of this is internal employees, and so we'll see if they sell. It'd be unlikely for him to sell before doing a merger with Tesla. Also, he has the ability to put his shares up for collateral and not sell them, which is what he mostly does, so that he doesn't incur taxes. So I think this is going to be much less impactful than this right here. Um, we'll see. The other big thing, where as this float goes up, so the amount of shares available, index funds will more and more allow, based off of their criteria for investing in companies. SpaceX will become more and more
Mhm.
allowed to be invested in by these index funds. So that would be an upward force. We'll see how much the upward force of index funds investing versus insider selling, and whoever is the majority force will determine if it goes up or down.
Mhm.
All right, last slide. These are three merger name stories that I'll go quickly through. So EasyJet is a European low cost commercial flight provider, and it's being taken into a private company, a private takeover for 5.5 billion pounds. It's going to go into this company called Castle Lake, is a private equity owner, with Apollo, which is a U.S. Private equity manager, putting up most of the cash to buy out this company. Very interesting to see. I don't think it'll affect us too much, or the U.S. markets of our airlines, but we've definitely, my family has flown EasyJet while we're in Europe, and we'll see if the private equity will make it even more bare bones, which is likely. So we'll see. Visa.
Yeah, so this one, um, it's kind of it's a little bit of inside baseball around how things work, what the inner workings are of credit card transactions and debit cards. Um, the banks think that owning Fiserv may allow them to be free from limits imposed on interchange fees on debit card transactions. Um, I don't know all the regulatory insider baseball, but I mean it's partially about trying to increase the fees, the hidden fees that banks are going to be able to are you know banks love fees, and so this is an effort to expand their power to levy fees.
Yeah, it's competing with the Visa and Mastercard networks.
Mhm.
Fiserv is more of a debit card background
Right.
provider. So if they buy out the software provider, they'll have more control over it and might be able to, eat away at some of the margin that Visa Mastercard has.
Mhm.
We'll see. This is reportedly considering acquiring, so we'll see if it actually goes through, and it probably won't affect you either way. But it was definitely big news in finance about a few weeks ago.
And then the last one there, Warner, I'm sorry, the Writers Guild of America. When I see the W, I think, is that Warner something? Writers Guild of America is suing to block the merger between Paramount, who's buying Warner Brothers Discovery. So the Writers Guild thinks that that'll just give them way too much power in terms of their negotiations with the writers. Uh, Probably actors and other guilds are probably gonna, file friendly briefs so along as this lawsuit works its way through. Um, it's interesting, also because Oracle is a little bit strapped for cash, and Larry Ellison has pledged his personal shares to help his son, who owns um, Paramount, in order to help get this merger going. So there's a family dynamic part of that. There's the Oracle story is having some kind of impact on this, or this will have impact on them potentially. If those Oracle shares are kind of tied up in this longer and longer, and we'll see. Hopefully, I mean, my view is I hate the merger, just because Warner Brothers is, one of the last old line studios. They take big bets and make interesting movies. And, you know, there are other studios that do that, but they're the smaller, newer studios like A24. And, so I like to see more diversity when it comes to movie studios, and less consolidation. But that's just my personal my personal beef.
Yeah, we'll see if it goes through. I don't know how strong this lawsuit actually is. It'll probably slow things down potentially, and it being slower might cause some of the funding to have issues. So it could inadvertently prevent the merger, but we'll have to see. We talked about it at length last year and earlier this year, and we'll give updates if there are any. But mostly, this was just an interesting update to the merger situation.
Yeah, if it fails, uh, Paramount would have to pay Warner Brothers $7 billion. But even if it's delayed, I think it's June next year. They would have to start paying some delay fee, like $1.7 billion would be the initial number, according to the article that we had over there from Deadline.com, which is a site that a news a very reliable news site, but they cover film and TV a lot, along with politics.
Yeah. All right. Well, we're right on the 1 hour mark here, and I didn't see
Perfect.
uh, Q&As come through this month. So I think we'll just wrap it up here. And I appreciate everyone attending and or listening after the fact or on YouTube. Feel free to share the video and come back next month with your questions and such. We'd love to have you guys, and it's always fun to talk about the finance news and nerd out on this. All right.
Thank you, everyone. Thank you,
Have a nice,
Jeremy. Another great discussion.
have a nice night, everyone. Bye bye.
Bye.